In January 2016, you put $100,000 into a checking account. You didn't touch it. No fees, no withdrawals. A decade of safety and discipline. In April 2026, you check the balance. It says $100,000. Your money is all there. Except it isn't. The purchasing power of that $100,000, what it can actually buy, has declined to approximately $73,000 in 2016 dollars. The number on the screen did not change. Your real wealth dropped by $27,000. Inflation did not announce itself. It did not send a bill. It did not appear on any statement. It simply eroded the value of your money at roughly 3.2% per year, compounding silently across 10 years, and the result is that a full quarter of your savings has disappeared without a single dollar leaving your account. This is the least discussed, most dangerous force in personal finance. And today we're going to quantify it with actual numbers, asset class by asset class, so you can stop being a victim of it. Let's start with the mechanics of how inflation compounds before we get into the specifics of 2026. The rule of 70 is a mental math shortcut for compounding. Divide 70 by the annual inflation rate to find how many years it takes for prices to double, or equivalently, how many years it takes for your cash to lose half its purchasing power. At 2% inflation, prices double in 35 years. At 3.5% inflation, they double in 20 years. At 7%, which the US experienced briefly in 2021 to 2022, prices double in 10 years. Here is the United States CPI data for recent decades. 1990 to 2000, average inflation 3%. 2000 to 2010, average inflation 2.6%. 2010 to 2020, average inflation 1.8%. 2020 to 2026, average inflation 4.8%, driven by the 2021 to 2022 surge to 9.1% and gradual moderation back toward 3.0 to 3.5% in 2024 to 2026. The aggregate effect over these 36 years, $1 in 1990 has the purchasing power of approximately 40 cents in 2026. If your grandparent hid $10,000 in a mattress in 1990, it is worth $4,000 in real purchasing terms today. The mattress did not steal it. Time and inflation did. The practical implication: any asset that does not grow at or above the inflation rate is shrinking in real value. Cash does not grow, it merely holds its nominal number. Every year your cash earns less than inflation, you are getting poorer, measured accurately. The standard personal finance advice is to hold 3 to 6 months of expenses in an emergency fund. This is correct. The problem is that many people hold far more to 12 months, 18 months, or in some cases years of expenses in cash, because cash feels safe. Cash drag is the term for the return penalty paid on excess cash holdings. Let's quantify it precisely. If you hold $50,000 in a standard bank checking account paying 0.01% APY, which is still the rate at many traditional banks in 2026, your annual return is $5. Against 3.5% core inflation, your real return is negative 3.49%. In dollar terms, you lose $1,745 per year in purchasing power on that $50,000. Over 5 years, compounding, approximately $9,200 in lost real value. That is the cost of keeping $50,000 in a checking account instead of a productive asset. It is not dramatic in any single year, it is invisible, gradual, and inexorable. That is what makes it dangerous. If someone took $9,200 from your account directly, you would notice and act. Inflation takes it slowly and you attribute it to prices going up rather than recognizing it as your cash's failure to keep pace. Now consider the emergency fund itself. A properly sized emergency fund for someone with $4,000 in monthly expenses is $12,000 to $24,000, 3 to 6 months. That amount should be in a high-yield savings account, not a checking account, and not exceeded materially beyond that range unless you have specific reasons: irregular income, job instability. The excess beyond 6 months should be invested. Not speculated, invested. There is a distinction. Investing excess cash in a broad total market index fund is not gambling. Leaving it in a checking account earning 0.01% is not safety. It is a guaranteed slow loss. Many viewers will push back here. But I moved my emergency fund to a high-yield savings account. I'm earning 4.5% APY. Problem solved. Not quite. And this requires precise language to explain correctly. In 2026, the best high-yield savings accounts offer approximately 4.3% to 4.7% APY. Let's use 4.5% as the benchmark. That sounds strong, and compared to 0.01% in a checking account, it is dramatically better. But the goal is not to beat your checking account. The goal is to preserve and grow purchasing power. Core inflation, the Federal Reserve's preferred measure, which excludes volatile food and energy prices, is running approximately 3.0% to 3.5% in 2026. Headline CPI is approximately 3.0% to 3.5% as well. Your HYSA at 4.5% produces a real return, the return above inflation, of approximately 1% to 1.5%. On $20,000 in a HYSA, your real gain is $200 to $300 per year. That is better than zero. That is not nothing. But here is the critical point: 4.5% HYSA rates are not permanent. They are tied to the federal funds rate, which changes with Federal Reserve policy. When the Fed cuts rates, as it is expected to continue doing through 2026 and 2027, HYSA rates will follow. They could be back at 2.5% to 3.0% within 18 months. And if inflation remains at 3%, your real return falls back toward zero or negative. HYSA rates are variable. Inflation is persistent. Counting on a HYSA to reliably beat inflation over decades is not a plan, it is a bet on favorable policy alignment that historically has not held. The HYSA is the right place for your emergency fund and short-term savings. It is not a substitute for inflation-protecting investments in your long-term wealth. Let's compare how major asset classes have performed against inflation historically. These are real returns, returns above and beyond the inflation rate. Cash and checking accounts, real return of approximately -2% to -3% per year over long periods, depending on the interest rate environment. You are consistently losing purchasing power. Short-term government bonds, real return of approximately 0% to 0.5% over long periods. Barely keeping pace with inflation, with the rate highly sensitive to when you hold them. Intermediate bonds, represented by BND, real return of approximately 1.5% to 2.5% over the past 30 years. A modest but real buffer over inflation, sufficient for short to medium holds, insufficient for long-term wealth building. U.S. stocks, total market, real return of approximately 7% to 8% per year over the past 30 years after inflation. This is the most reliable long-run hedge against inflation that retail investors can access. A $100,000 investment in the total U.S. market in 2016 is worth approximately $230,000 in 2026, not $73,000 like the checking account scenario. That is the spread between inflation and equity investment, $157,000 over 10 years on the same starting amount. Real estate, real returns of approximately 1% to 3% annually in price appreciation, plus the value of the housing service you consume or rental income generated. Real estate is an effective inflation hedge primarily because it is a leveraged hard asset. A mortgage allows you to control $300,000 of asset with $30,000 in equity. The asset inflates, the debt does not. Gold, real return of approximately 0% to 1% over very long periods. Gold is a popular inflation hedge narrative, but the data does not support it as a reliable inflation hedge over periods shorter than 20 to 30 years. In the 1980s and 1990s, gold significantly underperformed inflation. The clear data-driven conclusion:
productive assets, equities, and real estate are the only asset classes that reliably outpace inflation over long periods.
Everything else is maintenance at best, losses at worst. For investors who specifically want guaranteed inflation protection without equity risk, Treasury inflation-protected securities (TIPS) are the purpose-built tool. TIPS are U.S. government bonds whose principal value adjusts with CPI. If you hold $10,000 in TIPS and inflation runs 3.5% over the next year, your principal adjusts to $10,350.
The coupon interest is then paid on the adjusted principal. When TIPS mature, you receive the higher of the original or inflation-adjusted principal. In plain terms, TIPS cannot fall behind inflation in purchasing power, assuming you hold to maturity. They are a guaranteed real return instrument backed by the U.S. government. Current TIPS yields in 2026, approximately 1.5% to 2.0% real yield for 10-year TIPS. Meaning you earn 1.5% to 2.0% above whatever CPI turns out to be. On $100,000 in 10-year TIPS at 1.7% real yield, you earn $1,700 per year above inflation, guaranteed. You can buy TIPS directly at treasurydirect.gov with no fees, or hold the Vanguard Short-Term Inflation-Protected Securities ETF, ticker VTIP, at 0.04% expense ratio for more liquidity. iBonds, the savings bond version, offered a compelling 9.62% rate during the 2022 inflation spike and remain a useful tool. The current rate adjusts every 6 months based on CPI. Maximum annual purchase, $10,000 per person. iBonds are best for the portion of your emergency fund or near-term savings that you want guaranteed inflation protection on without equity risk. TIPS belong in tax-advantaged accounts. The principal adjustments are taxed as ordinary income annually even if not paid until maturity, which creates phantom income in taxable accounts. The strategy for protecting your wealth from inflation is not complicated. It is sequential and based on the time horizon of each dollar. Dollars you need within 12 months, HYSA or iBonds. Accept the modest real return. These dollars' job is availability, not growth. Dollars you won't need for 2 to 5 years, TIPS, short-term bond ladder, or a more conservative mixed allocation. These need to beat inflation reliably without the full volatility of equities. Dollars you won't need for 5 or more years, equities, specifically, low-cost total market index funds. This is the only asset class with documented long-run returns that substantially outpace inflation. At 7% real return versus 3% inflation, a dollar invested for 20 years multiplies to $3.87 in real purchasing power. The same dollar in cash becomes worth 54 cents. The most common wealth destruction error is holding money in the wrong category for its time horizon. Keeping 5-year money in a checking account because it feels safe costs real wealth. Putting emergency funds into equities that might decline 40% right when you need them is the opposite error. The framework is, match each dollar's account type to its use timeline. Then choose the highest returning appropriate vehicle for that timeline. The total market index fund is the answer for long horizon dollars. HYSA is the answer for short horizon dollars. TIPS and iBonds fill the middle. Inflation does not wait for you to notice. The $27,000 that disappeared from that $100,000 checking account over 10 years did not come back when you finally moved the money. It is gone. The question is whether the next 10 years look the same. For actions, this week. First, calculate your actual cash holdings. Add up every dollar in checking accounts, savings accounts, and any money market funds. Subtract 3 to 6 months of your monthly expenses. That is your excess cash, the amount that is actively losing purchasing power with no corresponding benefit. Second, open a high-yield savings account if you don't have one. Move your emergency fund there. In 2026, Marcus by Goldman Sachs, Ally Bank, and Discover Bank are among the highest rate options at 4.3% to 4.6% APY. Moving $15,000 from a 0.01% checking account to a 4.5% HYSA adds $670 per year instantly.
Third, for any cash beyond your emergency fund that you won't need for more than 5 years, open or fund a brokerage account and invest in VTI or FCROX.
This is not timing the market. This is the long-run allocation that every year of delay costs.
Fourth, go to treasurydirect.gov and purchase I-bonds up to $10,000 this year. Use them as a component of your emergency fund for the portion you're confident you won't need within 12 months. The 12-month lockup is the only constraint. After that, they are liquid with a minor interest penalty in the first 5 years.
Inflation is not a news headline.
It is a permanent feature of modern economies. The only question is whether your portfolio is designed to fight it or absorb it.
Fight it.
Word count, 1/340 duration, 10-minute end card, video number 29, next topic in series.